In February 2020, the stock market was at an all-time high. A few weeks later, it crashed faster than almost anything we had seen in modern market history. Businesses closed, millions of people lost their jobs, the economy was falling into the worst shock since the Great Depression. And then, while the real economy was still getting worse, the stock market started rising again. That is the part that confuses people. How can the market go up when people are losing jobs? How can Wall Street recover when Main Street is still in pain? It feels wrong, it feels disconnected. And honestly, if you have ever looked at that and thought, this makes no sense, I get it, but there is a real explanation. The stock market is not the economy. They are related, of course, but they are not the same thing. Welcome back to Chloe Capital Brief. I'm Chloe, and here we explain markets, money, and investing in a simple way. And as always, this is for education only, not financial advice. Let's get into it. The most important difference is this. The economy mostly tells you what is happening now or what just happened. The stock market is trying to price what happens next. GDP, unemployment, retail sales, consumer spending. These are important numbers, but they usually look backward. They tell you what happened last month, last quarter, or during a period that has already passed. The market works differently. A stock price is not only based on what a company is earning today, it is based on what investors think that company can earn in the future. 6 months from now, a year from now, maybe several years from. Now, that is why stocks can sometimes rise before the economy looks better. The market is not saying everything is fine today. It is saying investors think the future may be less bad than they feared that difference matters. Think of it like this, The economy is like a report telling you what yesterday's weather was. The stock market is more like a forecast trying to guess next week's weather. The forecast can be wrong. Markets are wrong all the time. But markets are always trying to look forward. That is why bad economic news does not always push stocks lower. Sometimes the market already expected it. Sometimes investors expected something even worse. And sometimes the market has already moved on to the next question. What happens after this? Benjamin Graham, the investor who mentored Warren Buffett, had a famous way of describing it. In the short run, the market is a voting machine. In the long run, it is a weighing machine. In the short term, prices move on fear, hope, panic, and expectations. Over time, they have to come back to real business value. So when the economy looks terrible but the market starts rising, it does not always mean investors are ignoring reality. Sometimes they are trying to price the next reality. Now let's walk through the 5 reasons this can happen. The first reason is simple. Markets price the future, not the present. Imagine a company that sells equipment to restaurants. A recession hits, restaurants close, orders collapse, revenue looks terrible. If you look only at today, the business looks awful. But investors are asking something else. Will the company survive? Will restaurants reopen? Will demand come back? And if the answer is yes, what are those future profits worth today? That is how stocks work. They are not priced only on today's earnings. They are priced on expected future earnings. So when things are still bad, but investors begin to believe the worst is over, stocks can turn around before the economic data improves. That is why the market can rise while unemployment is still going up to normal people. That can look insane to the market. The question is not only how bad is it now? The question is, will it still be this bad later? The second reason is that the stock market is not Main Street. When people say the market is going up, they usually mean an index like the S&P 500. But the S&P 500 is not the whole economy. It is mostly large public companies. Apple, Microsoft, Amazon, Google, JP Morgan, and other major corporations. These are not the same as your local restaurant, dry cleaner, small shop, or family business. Large companies often have more cash, better access to credit, stronger balance sheets, and global revenue. Some of them can survive a downturn much more easily than small businesses can. So a recession can crush Main Street while the biggest companies in the index hold up better than expected. That does not mean the economy is healthy. It means the index is not measuring the average person's life. It is measuring the market value of large public companies. And those are very different things. The third reason is the Federal Reserve. In a downturn, the Fed can have a huge impact on financial markets when the Fed cuts interest rates. Safe investments like bonds usually become less attractive. At the same time, borrowing becomes cheaper for companies that can make stocks look more valuable. The Fed can also inject liquidity into the financial system. It can buy assets, support credit markets, and signal that it will not allow the system to completely freeze. Investors pay attention to that. In 2020, the Fed moved extremely fast, rates were cut close to zero, and massive support was pushed into the financial system. The economy was still collapsing, but markets started pricing in the rescue. This is why traders often talk about the Fed put. It is the belief that if markets fall far enough, the central bank may step in. That belief changes behavior. Investors are not only asking, how bad is the economy? They are also asking, how strong will the response be? And if the response looks powerful enough, the market can rebound before the real economy does. The fourth reason is uncertainty. Markets do not only hate bad news, they hate not knowing how bad the bad news could get. That is an important difference. If investors can estimate the damage, they can start pricing it. But if nobody knows where the bottom is, panic can take over. That is what happened in March 2020. The fear was not just that the economy was weak. The fear was that nobody knew how long the shutdowns would last, how many companies would fail, or whether the financial system would stay stable. The market was falling because the problem had no clear shape. Then, once investors started to understand the crisis better, the market could stabilize even though the news was still terrible. That sounds strange, but it happens often. Markets do not always need good news to recover. Sometimes they just need less uncertainty. The fifth reason is the hardest one, but it explains why this feels so unfair. Stock ownership is not evenly distributed. Most stocks are owned by wealthier households. So when the market rallies during a recession, the benefits mostly go to people who already own financial assets. But for many people, the economy is not a chart. It is a paycheck, a job, a rent payment, a business that may not survive. So yes, the market can rise for rational reasons, but that does not mean ordinary people are doing fine. A rising stock market mainly tells you that investors are willing to pay more for future corporate profits. It does not tell you that workers are secure, small businesses are safe, or households are comfortable. That is why the phrase, the stock market is not the economy, matters so much. Now let's go back to 2020, because it shows this clearly. In January and February, the market was near record highs. There were concerns about a virus, but Wall Street was not fully alarmed yet. Then, in late February and March, everything changed. The S&P 500 fell about 34% in just a few weeks. It was one of the fastest bear markets in history. But here is the important part. The market bottomed on March 23, 2020. On that day, the real economy had not recovered. In fact, the worst economic data was still ahead. Unemployment had not even fully shown up in the official numbers yet. Lockdowns were still spreading, businesses were still closing. So why did the market stop falling? Because investors began to see the response. The Federal Reserve announced massive support. Congress was moving toward major stimulus. The system was being flooded with liquidity. The crisis was still brutal, but it had a clearer shape. And once the market could see the shape of the crisis, it started looking past the worst moment. Through April and May, unemployment surged. The real economy was still in pain, but the market rose. That does not mean investors thought the suffering was fake. It means they were betting the damage would be temporary, that policy support would be large, and that corporate profits would eventually recover. The market was not pricing today. It was pricing what investors believed came next. But this does not mean markets are always right. They are not. The 2008 financial crisis is the counterexample. That market did not bounce back in a few weeks. It fell for many months because the uncertainty lasted much longer. Investors did not know which banks would survive. They did not know how much damage was hidden inside the financial system. They did not know whether credit markets would freeze. The problem stayed unclear for a long time, so the market kept falling. That is why the lesson is not stocks always recover quickly. The real lesson is this. The stock market is a forward-looking pricing machine. Sometimes it sees recovery early. Sometimes it gets too optimistic. Sometimes it is completely wrong, but it is almost never just describing how people feel today. And that is the key. A rising market does not mean everyone is okay. It does not mean wages are rising. It does not mean small businesses are saved. It does not mean people who lost jobs suddenly feel secure again. It only means investors are paying more for expected future earnings. That is useful information, but it is not the whole story. So the next time you see the stock market rising while the economy still looks bad, remember this. The market is not a mirror of today's pain. It is a bet on tomorrow's profits. That bet may be right, it may be wrong, but it explains why stocks can move before the economy feels better. And once you understand that, the market starts to look a little less mysterious. That's all for today. I hope this helped you understand why the stock market can rise even when the economy looks terrible. If you found this helpful, like the video, subscribe, and follow Chloe Capital Brief for more simple explanations of markets, money, and investing. Thanks for watching, and I'll see you in the next one.